So let's talk about mortgage insurance. What is it? Why do I have to have it? When do I have to have it? How long do I have to have it for? What does it protect? So quite simply, mortgage insurance is required typically when you put less than a 20% down payment on your home. Your lender is most of the time going to require that you carry mortgage insurance. Mortgage insurance doesn't necessarily help you in any way as a homeowner. It doesn't protect you if there's something that happens to the property. That's what your homeowner's insurance is for. The purpose of mortgage insurance is that if you miss your mortgage payment, it helps to cover that payment back to the lender. So when you have a low down payment, the lower your down payment on your home purchase, the larger the risk to the lender. So if the lender is lending 95% of the home purchase and you're only bringing 5%, well, really the lender's taking 95% of the risk there. So if you're at 80% loan to value, meaning you financed at least 80% of your home's purchase or more, that's too much risk to the lender. So they're not necessarily comfortable to finance that amount without some sort of protection. So that's what mortgage insurance does. It would pay the lender back in the event that you defaulted on your home. So that's mortgage insurance in a nutshell. Now you'll hear this referred to as MI or PMI. And then that is typically when it's going to be required is when you're putting less than 20% down. The length of time that you have to hold mortgage insurance depends on your loan program. Typically, if you have a conventional loan, once you hit 80% loan to value, so for example, if you put a 5% down payment, each month you make a payment, it reduces the balance on your loan. Once you get to the point where you now have 20% equity based on the home purchase, the mortgage insurance can go away. So you don't have to pay it forever in most cases. It would go away at some point in time, but usually that takes a little bit of time depending on how much money you've put down. Mortgage insurance, the premium depends on factors on your loan such as your debt to income ratio, your credit score. Usually it's a percentage of the loan amount. So on a $300,000 home purchase, if you put 5% down and you finance the difference, which I think is about $285, you might see something like $50 a month is mortgage insurance that you're paying. Now, again, that doesn't really protect you in any way. It's not necessarily a benefit to you. It just incentivizes the lender to allow for lower down payment purchases so that everybody doesn't have to have 20% of the home purchase whenever they go to buy a house. It allows people to buy the home with less of a down payment and acts as a protection against the default on the mortgage. So think of it kind of like homeowners insurance, but for the mortgage company, essentially.